So a lot of people we work with are interested in cash value life insurance to pay off debt. For example, I recently had a meeting with someone. He lives out in California. He makes about $200,000 per year, but he lives almost paycheck to paycheck. The reason why is because he had to buy a home out there. Homes are extremely expensive out in California. And then he spent a ton of money renovating it, which he primarily put on credit cards, which now he's in a position where the home is great, but he can't pay those credit card debts down. He's paying interest only, and the interest only payments on his credit card debt and personal loan debt amounts to more than $40,000 per year. So he is just getting killed with credit card debt. He's got a large mortgage too, and he's paycheck to paycheck at $200,000 per year. So in his particular situation, he's got about $40,000 saved up in cash, and he's asking, can a whole life insurance policy help me at all? Yes, I can just take some of my cash and begin paying down the debt and just have the snowball effect. But what I'm interested in is taking that $40,000, putting it into a life insurance policy first, and then borrowing against it to pay off the debt. Why he wants to do that is because if he puts that $40,000 into his policy first, he'll continue to receive dividends and interest on that even when he pulls it out to pay off the debt. So think of it this way. If I put 40 grand into a policy today and 20 years from now, it's going to be worth $200,000. Well, if I put 40 in it, take it out, use it to pay off other debt, and then repay that loan in 20 years, it's still going to be worth that $200,000. So that's why he wants to use the cash value life insurance policy. So it can work, but with a situation like this, you do have to, one, have all of the information. He was very organized. He provided each of his credit cards, each of the balances, each of the interest rates, and each of the monthly payments. And then number two, it does require discipline. Fortunately, his income is high. So in a case like that, what we did was just lay everything out on a spreadsheet so we can see, here's what your life looks like right now if you just keep doing what you're doing. What does it look like, though, if you take this $40K that you have, put it into a policy? It's not all of his cash, by the way. We wouldn't recommend that. But when we take that $40K, put it into a policy, take a loan against the policy, and pay off 2 credit cards that have the highest interest rates and are taking up the most cash flow every month as well. When we pay off those debts, what we've now done is taken credit cards that have interest rates more than 25% and consolidated them into a fixed loan interest rate of 5% with his whole life insurance policy. So we saved a lot of interest, which is nice. Now, the cash flow, which between those 2 credit cards was about $1,000 per month. What we've now done with that is we take that and begin to repay the policy loan. When you repay policy loans, that immediately restores cash value or equity, which you can then borrow out and pay off more credit cards. So what we're doing is taking loans against the policy to pay off existing credit card debts. When those credit card debts are paid off, we're taking the cash flow that was going toward the credit cards and paying back the policy loan. So he's using it like a personal line of credit. Now, the advantage to this is all the meanwhile, year over year, that cash value gets larger and larger because he continues to earn dividends and interest on it, even though it's borrowed out and being used to pay off the debt. So when this strategy is complete, when the cycle is finished after about 7 or 8 years, that initial 40 grand has compounded for him the entire time. And he also plans on adding about another $2,000 to $3,000 per year. We built that into the plan. As far as how we're going to fund it is from some of the debt cash flow. So using a whole life insurance policy to pay off debt can work very, very well. It, for him, is alleviating a ton of stress because it's saving him interest. He now has cash flow that's required to go to credit card companies that with a policy, you don't have that same requirement. We mentioned it takes discipline because we recommend it, but life insurance loans don't impact your credit score or anything like that. So boy, does that alleviate stress for him. He sees his credit score improve. He's got more liquidity now because he's got less debt via the credit card companies and money compounding in the policy, so he can clear that bad debt and see that money continue to appreciate. So it puts him in a better position. He has less stress. And when it's all said and done, the money's appreciated to a large balance where, because he continues to add money, he'll have a couple $100,000. So that is one example of how we're using a cash value life insurance policy to pay off bad debt. I hope this helps.